Welcome to our Switch On Hot Picks for Week 10, 2026. This week, it's all about the war. It's all about the joint strikes from the United States and Israel on Iran. It's escalated geopolitical tensions to levels we haven't seen in quite some time. So the key markets that we're going to be looking at, UK oil, US oil, the dollar index. Also, we're going to look at gold, the VIX, and the US 500. Okay, let's get started. UK oil, the international benchmark for the global crude oil trade. Very, very interesting. A lot of folks trade WTI and US oil, but they don't trade UK oil. UK oil is a big market, and if you're interested in trading energies, it definitely should be on your radar, especially as we roll deeper into this war in the Middle East. Well, the bottom line is this. We opened gap up on the week. You can see we have a gap on our weekly chart, 75.75 to 73.54. Typically, when we're talking about commodities, there's a few rules with commodities trading. One of them is gaps get filled, and gaps get filled. This is an interesting zone and one that I'm going to be watching for the near term. I would be very surprised if we don't sell off and test that level ahead of maybe another breaking news item or maybe after another breaking news item. So always remember, gaps are a big deal in the commodities markets. Typically, they're all traded eventually. So let's go ahead and throw some Fibonacci retracements on this market. Spike low there up to our upper extreme. 82.48 was the upper extreme after Monday's open. Right now, we sort of sold off right down to that 38%, 76.46 and bounced. So we're still bullish. We have a bullish bias here given the geopolitical situation. It's probably better to be long than short. However, the volatility is huge. The daily range on Monday was huge. So be careful. Whatever you do, be sure your risk management is dialed in appropriately. You don't want to lose a bunch of money in a situation that truly is chaotic. So this may or may not be outdated by the time you see this video. These markets are moving fast, but a little support zone down here at 72.74. Probably a pretty good area maybe to take a shot at a long. 50% of this zone, 74.60, right in the middle of that gap. So I'm watching that gap area closely. I think you're going to get a retracement down there, but you can't really trade that way just yet because the geopolitical situation is so explosive to the top side. Okay, that's UK oil. US oil, this is West Texas Intermediate, WTI crude. This is the US benchmark, and a lot of folks look to this as maybe being the premier pricing mechanism for oil. However, North Sea Brent's a big deal as well. So US oil available on the CME. You can see exactly what happened here on the daily. We had another big gap up here, opened right at 75. And that was an interesting level because typically when you have all this chaos in the markets and then the market opens right at 75, you start to understand how the pricing mechanism works. The market makers stepped up and they were scratching their heads saying, where do we put it? And they went with 75. Well, the sellers stepped in. They thought that was a little bit too much, drove price down, and now we have the gap area sort of established right around that 69.50 zone to that 68.08 zone, and we've also bounced above that 38% retracement of the daily. So a bullish bias here is warranted, probably robust support down here at 70.85. Right now we're printing 71, about $72. This is a big area, a lot of volatility and a lot of action. Whatever you do with US and UK oil, strong risk management. Make sure that you're using a stop loss somewhere on the board. Remember that any surprise out of the Iran situation, be it closure of the Strait of Hormuz, be it a supersonic missile supposedly hitting a U.S. aircraft carrier, a mass casualty event, maybe in Europe or in the United States from an Iran proxy. All those things can drive these markets north in a big, big way. So if you're shorting, make sure to use a stop, use proper leverage. And if you're going long, the same rules really apply. I mean, as soon as things, maybe a peace deal signed, maybe the new leadership in Iran wants to negotiate with the West. We don't know. This is volatility at its finest. Use your risk. Use your stop losses. As I always say, stops down, leverage in check, absolutely huge. So you're going to want to check that out. All right, the dollar index, sort of a big move up for the dollar index to open March's trade. You can see this is a monthly chart. We've only traded one day in March, and we had a big move of about 1% to the top side. I look at this as sort of a safe haven appeal of the U.S. dollar. We saw the dollar catching a lot of bids on Monday, and that was because the war broke out. In a lot of cases, the U.S. dollar is sort of a safe haven. It's often viewed as the ship with the least amount of rats. So you have a situation where currency traders just say, do I want to hold this? Do I want to hold that? Or do I want to just transition into the U.S. dollar? And most transition into the U.S. dollar, at least in the short term. And that's what we saw. I don't think this changes the overwhelming fundamentals towards the USD for 2026. I think you have a severe downtrend since Donald Trump was inaugurated back in January 2025. Just a stiff sell-off because we do believe that those rate cuts are coming later in the year. And if the war does expand and does escalate, you may see some bullish price action in the US dollar in the short term. But typically what happens in times of war is you're going to cut interest rates to stimulate economic growth and really help investors get involved back in the market with a little bit of confidence and maybe send a lot of folks back to work that may be out of work due to tightening economic conditions. It's a complex situation right now. We're still bearish the U.S. dollar, though. Definitely DXY 101.07. That 101 area is huge. We've also got a 13-month EMA right there at 99.46. So I would say 99.50 to 101 is robust topside resistance. I'd be surprised if that level's taken out anytime soon. Okay, this is a good look at gold. Everybody trades gold these days. Be careful if you're trading gold. This is interesting. We have a demand zone that's set up on this weekly Fibonacci retracement sequence right around 5,200. Now, as we're on the air here making this video, it's 53.75. Earlier today, it was right down in here, right around 52, 52.50. We thought maybe we were going to get an opportunity to buy the demand. That's going to be a real challenge to get any pullback at all in this market. However, if you do get a pullback, maybe from 54.19, 54.25, you got that 52 level really. All-time high is probably the next stop at 55.98, and that'll likely occur if you do see some sort of escalation out of Iran, which we're starting to see reports that is the case. So I'd be watching the all-time highs closely, maybe a little bit of two-way action there, but if you break above the all-time highs, I would be looking at 57.50 as the next port of call. Definitely an interesting dynamic for gold. You want to buy pullbacks, but do you get a pullback? It's tough. It's really, really difficult right now. So those are the key levels, though. If you do see the new highs get pushed, you may want to do something like this and just always be looking at that 38% retracement as a potential bidding opportunity. Something to think about there, but the pressure's definitely on. We have broke from 5,000. Interesting market dynamic. Okay, let's wrap it up with the US 500 and the VIX. Here's a good look at the VIX. Now, this is a yearly chart for the VIX, the CBOE Volatility Index. This measures volatility for the financial markets. It's used as Wall Street's fear gauge. The way that it's derived from deferred month options premiums on the S&P 500. So this is related directly to the S&P 500 and what traders think maybe those valuations are going to be worth down the line a few months. So we're looking at the VIX. A couple of things to point out. These spike highs are really no joke. So remember that we're depressed compared to these highs. So everybody is looking at the VIX, looking for signs of, oh boy, are we going into World War III? What's going to happen here? Well, take a look at what happened in 2008. The VIX was up there around 89. All right, take a look at what happened in COVID 2020. What did you have there? 85. What did you have right there in 2024? That was the unwinding of the yen trade. In August of that year, your high there was 65. The spike in the VIX last April was 60.13, and that was on the tails of tariff mania. Right now, we're still depressed. The long-term average, a pretty good barometer, is between 19 and 21. I lean heavily on 21. So you're going to want to keep an eye on 21. If we're above 21, then maybe our risk, our risk sentiment is a little bit higher than it usually is. But if it's below 21, typically times are pretty good. So we're starting to see the VIX drive above that. It was up 8% for Monday. What does that mean for stocks? Well, basically it boils down to this. The higher the VIX means that probably stocks are going to be coming off, and the lower the VIX probably means that those stocks are going to continue to build value over time. So US 500, what exactly do we have here for technicals? Not much. Not much. What I want to point out is really throughout this trading year, we have seen just rotation. Epic rotation. We had a test of those highs right up above 7,000, and then a significant sell-off down here in February. February's lows down here at 67.30. We have been trending sort of nowhere. We've been rotating sideways between these two levels. So in my view, you're probably going to you're either going to test the highs or you're going to break the lows. February's low, there's a big deal. If you do sell off beneath February's low, you're probably going much, much lower. So we're watching this closely. Remember, wars typically lead to a divestiture from risk assets like your stocks. US 500, though, hanging in there. Hasn't really seen the major sell-off that maybe we would have expected in the wake of such a big conflict or a big war. But right this minute, stocks are holding tough. So we're watching those two levels closely in the US 500. Very simply, downside support right in here, topside resistance up here. If you do break through this support zone, then you're probably going a little bit lower due to an escalation in the Iran-Israel-US war. All right, guys, there's a lot on the plate for this week's trade. That's just a quick look at our hot picks. Everybody's trading U.S. oil, UK oil. They're looking at gold and silver as well. Keep an eye on that VIX. If you see the volatility index really spike, then it's time to get a little bit concerned if you're holding long stocks. And then also that U.S. 500 in a deep rotational pattern here. It's definitely poised for a break. More than likely, the break will probably come to the downside, but you could just as easily see a peace deal and call them come back to the region, and then potentially you could be looking at a breakout over all-time highs. It's an interesting time to be in the markets, that's for sure. So as always, keep your risk dialed in, stops down, leverage in check, and trade the action well, and we'll see you soon.